Taiwan imposed a capital gains tax on stock sales for the first time ever this year. And to overcome opposition, the tax was essentially turned into a fairly tame stock transaction tax in its first 2 years. But majority KMT lawmakers proposed Thursday to water it down even further. They want to eliminate the minimal tax that was to kick in when Taiwan's benchmark stock index exceeded 8,500 points.
The KMT lawmakers' latest proposal on the capital gains tax would reduce investors' tax burden. Under the plan, the transaction tax kicking in when the index hits 8,500 points would be eliminated, and retail investors would be exempt from any tax. Only big investors who have already sold 1 billion NT in shares in the fiscal year would pay an extra 0.1% transaction tax on any additional sales of shares. One well-known retail investor and pundit criticized the KMT revision.
The original point of the tax was to go after big traders and leave small ones alone. Now they want to let even big traders off the hook, which basically means they won't collect any tax. Big investors will set up proxy accounts.
But the proposal seemed to give the Taiwan Stock Exchange a shot in the arm. The market's benchmark index reached a nearly 2-year high Thursday when it broke through the 8,400-point barrier. It closed nearly 1% higher at 8,392 on heavy turnover of 121 billion NT dollars. Despite the rally, opposition lawmakers were less than enthusiastic about the proposed revision.
The finance minister clearly said the government first wanted to simply put through a capital gains tax and then improve on it. But we never imagined that the improvement would create a tax that exists in name only.
Unhappy with the KMT plan, opposition lawmakers plan to propose a revision of their own next Monday at a meeting of the legislature's Finance Committee.